Morning, good afternoon, everyone. Good morning for people based in the US. Good afternoon for people based in Europe. Thank you for joining the analyst call. Today, we're going to have a great session. We do have the research team Avengers, Adrian, Lena, and Tom. I really can't wait to share with you guys the latest trends and what we're seeing in the market. August was a pretty eventful month, but there is a lot that we can unpack with blockchain data, but also looking at the spot market and the futures market in crypto. So first, we're going to get started with the current state of the market. And then we're going to break down some of the top trends that we're seeing currently within the crypto industry and how this is going to shape the next few weeks and months. So number one, Ethereum is remaining the most dominant smart contract platform, and there is a lot to unpack with future upgrades. U.S. Treasuries on the blockchain are becoming the more dominant and I would say prerequisite to have access to strategies on the blockchain. And then last but not least, we're seeing more and more liquidity moving on-chain and moving away from centralized exchanges. And that's a clear trend that is here to stay. So let's get started with the market update first. Adrian, tell us what you're seeing today, especially when it comes to the technical analysis, the price support and resistance levels of Bitcoin.
Yeah, absolutely. I think it's worth looking at the chart because there has been low liquidity and low volatility over the last couple of weeks and months, basically during the summer. And if you watched our previous analyst call, there was one question about what could happen next. And our colleague Carlos and I, we said, obviously, when the volatility squeezes to such a level, most of the times it anticipates a bigger move. And that's exactly what happened. So around 1.5 weeks ago, obviously, we broke out to the downside. We're going to hear a little bit more why that happened later on, but obviously there was a combination of factors. But then recently, especially since yesterday, where we heard the news that Grayscale succeeded against the SEC for now, but obviously it sparked some euphoria in the market, which is reflected in the price. And if we look at the levels, the blue line you can see here, that's a 200-day moving average. 1.5 weeks ago, we lost that support and we broke below. However, we were able to hold that key support level around 25K, which is the purple line. You can see here the 25K, in my opinion, is a very key support level. We see in the past it acted as support and resistance multiple times. And this time around, again, we bounced from that 25K. And then obviously at the moment, since the pump yesterday, we're trying to regain the 200-day moving average. Also, if you look below, we can see, yeah, the volatility has been really low, but at the same time, after that drop below to almost 25K, we saw the RSI signaled a very oversold level, which could have been an indication that we might see a pullback to the upside, but that's just something to keep in mind. And now, obviously, we want to see what's going to happen next. If we move to the next chart, because obviously we rallied on the back of some good news the last 24, 48 hours. However, it's important to note that September usually is a very challenging month for Bitcoin. What we can see here is the historical performance per month for Bitcoin. And as you can see, September is by far the worst performing and most challenging month for Bitcoin in terms of performance. It's called the September effect. It doesn't only affect Bitcoin, it affects the broader market. That's why I added the chart of the S&P 500, and where we can see, historically speaking, September also has been the worst month in history for the broader equity markets as well. So again, that doesn't mean it will happen again. It doesn't need to be like this time, but obviously it's something to keep in mind.
And I think interestingly as well, when you look at these metrics of the returns of Bitcoin month over month and year over year, what is interesting is that the outlier in volatility does not happen in September. Of course, past performance is not indicative of future results, but the worst performance and the best performances, especially here for the worst performances, because September is going to be a pretty tough month, we haven't seen more than 2 or 3 digits drawdowns compared to, for example, anything around let's say, June 2022, for example, last year, when we had almost a 40% drawdown. We haven't really seen that in September, despite the fact that in the past, Bitcoin was a tinier asset class and with, of course, higher volatility levels, right? So these are the things that you need to keep in mind as well, that the outliers in volatility, especially the downside volatility, if you're just looking at the Sortino ratio, this does not happen in September. But of course, as you had mentioned, past performance is not indicative of future results. All right, good. Right now, let's look into the current state of the Bitcoin cycles. So we had several bear markets in the past. We had the one that was very long, actually, in 2015, from 2015 to early 2016. And then we had also the bear market after the ICO boom of 2017, 2018, that actually lingered to early 2020. And now currently we're seeing that just looking at the price movements, we had actually today the longest bear market in history. But there is more metrics and variables that should be taken into consideration as part of this equation. Adrian?
No, absolutely. I mentioned that we could look at the time between 2019 up to 2021. It could be seen as a longer bear market. Obviously, here we look at the year-over-year change, and therefore in between, in 2019, when we had more liquidity in the markets, we saw a Bitcoin rally at this point as well. But obviously, in terms of sentiment, in terms of Google searches, there wasn't really a lot of interest and hype around Bitcoin. And it does feel the same at the moment as well. If we look at all the metrics or the overall sentiment in the market, it's very much subdued and low compared to when we actually entered the bull market.
Yeah, absolutely. And then like beyond just year-over-year price performance, we're also looking into other fundamental metrics that really matters, right? We're looking at, for example, venture capital funding into crypto companies. We're looking into the transactional value and volume over time. We're looking into the growth of the users and the revenue of the miners as well to secure Bitcoin network and other crypto assets platforms. So there is more metrics to take into consideration. Price is just the tip of the iceberg. And usually price is the lagging indicator of the fundamentals as well. So there's a lot to unpack here, but we're going to move on to also other variables that really were, I would say, the catalyst of the market. So let's move on to Lina. Lina, tell us about volatility levels and liquidation that we've seen in the market.
So the Bitcoin's annualized volatility hit a 5-year low. So since July 30th, which coincided with the curve exploit, until August 17th, market sentiment was a bit charged. People were wary. No one is selling like huge amounts or buying huge amounts. It was a bit stagnant until August 17th, when rumors broke out about SpaceX's Bitcoin holdings. And other factors as well could have contributed to this sell-off or this liquidation on the macro level. Like, for example, the Federal Reserve in the FOMC meeting minutes, they indicated that the Federal Reserve might have more hikes in the coming months. That could have exacerbated market sentiment. Also, the Chinese real estate giant filed for Chapter 15 in the US bankruptcy. That could have also shaken the market sentiment. In the late August, we've seen over $1 billion in liquidations, more long so than short. In the curve exploit, I'd like to highlight that almost 70% has recovered from the exploited funds. Just to recap, in case anyone here missed it, Curve got exploited on 3 pools. Curve is one of the largest DEXs specialized with stablecoin trades. Curve fell by 26% over the past month, although the TVL grew almost 30% month over month, thanks to the exploited funds that have returned. And here we can really ask ourselves, will users be able to trust? Does that indicate that people are trusting Curve as a DEX, given that the recovery period was in a significantly short time or brief time? And yeah, that is the question of the hour. And I think Tom here is the best to answer that. Tom, can you tell us why would users trust, or is that a battle test for user trust in Curve? And or will there be more work to be done on that front?
Thanks a lot, Lina. One point which is very important to note is the exploit is not due to smart contract code from Curve. It's due to the smart contract language that has an internal issue in an earlier version. And it shows an incentive issue because when people are auditing projects, smart contracts, there are a lot of incentives because the AUM is high, and then projects usually have a lot of treasury, a lot of funds to fund the auditing reports. However, due to the smart contract itself, a lot of time is a public good. There aren't a lot of auditing firms that are going to look at it for free. And therefore, previously, we've seen that the new updated versions, there are 5 rolling out, but then the previous versions, there's no one looking at it and analyze whether there is a bug, there's an issue on that, and therefore, there's an issue happen on Curve itself. And another point to note is that this exploit is only around 61 million, which is less than 10% of the TVL of Curve. So Curve is around 2 billion total value logged on this protocol. So this exploit is really minimal. And people are understanding that it's not an exact issue happening on Curve itself, it's on the smart contract language. And therefore, we're seeing that users' trust have been building up back quite significantly.
And that's why when we are looking at some of these experimental programming languages, some of the most important themes that we're going to look into in crypto are how do we have antiviruses? How do we ensure that we have the right software protections to avoid such issues? Or actually the security practices to ensure that we know in real time whether a programming language has a vulnerability, right? Think about how we upgrade our operating systems on our smartphones, right? Whether you're using Android or you're using iOS, you always have upgrades. You have to upgrade your iPhone or you have to upgrade your MacBook in order to basically make sure that you don't have these liabilities from the previous versions. And these are the things that we're going to see more and more in crypto in real time to have some of these issues being solved so that anyone can actually upgrade in a promptly manner. All right, Adrian, so you told us that Ethereum is king. EVM stands for Ethereum Virtual Machines. This is the operating system of Ethereum to make it work, very similar to the iOS for your iPhone. Adrian, tell us why this is an important theme, especially for this month.
Yes, we want to give you a recap of what happened last month or the previous weeks, but always tie it together into a broader theme and a thesis that we have going forward. Why EVM is king is due to several news that we could watch over the last month. First of all, we have Cello. Cello is a mobile-first layer 1 blockchain, and they proposed to migrate to Ethereum as a layer 2 protocol. And they're going to leverage the Optimism OP stack, which is also used by Base, for instance. Secondly, we have Phantom, which is another smart contract platform. And they have similar plans that they want to move from being a layer 1 on becoming a layer 2 on Ethereum. And it's quite significant because I think when you look at all those alternative layer 1s that were competing with Ethereum during the last bull run, they're under a lot of pressure right now. And I think Phantom is a good example. I think their TVL at peak during the last bull run was around $8 billion. While now, if we look at the numbers, they don't even have 60 million in total value locked. That kind of shows you the drain in liquidity and drain in TVL. And obviously those kind of projects, they need to make a strategic decision. Are they continuing to try to compete with Ethereum, or are they pivoting, changing their strategy and basically joining Ethereum? And I think that's exactly what we see. In order to prevent brain drain, also an exodus of developers and money, they basically join Ethereum. Then also, there's a lot of layer 1s wanting to become layer 2s, but also we have an influx of a lot of new layer 2 solutions. Consensus, which is the developer behind MetaMask, they also recently launched a layer 2 solution called Linea. And then obviously the big one was Base from Coinbase that also launched in the recent weeks. And Base is very interesting because there was a lot of hype around it. They also recently flipped Optimism and Arbitrum when it comes to transactions and daily active addresses. But again, the whole hype was initially driven by a meme coin frenzy. And then more recently, it was the hype around an application called Friend.tech. If you never heard about Friend.tech, it basically allows you, the user, to tokenize your Twitter account and other users can buy shares or tokens of that account. If this project specifically will survive and is sustainable, it has to be seen, but it's an interesting proof of concept when it comes to especially social tokens and SocialFi, how we want to call it. Again, the thing in DeFi and in general is always when there's a new project, a lot of users, they simply switch from one layer to another or from one application to another. So we're still going to be watching base, and it has to be seen if they can sustain their user growth. On the right side, you just see an overview about the Ethereum ecosystem dominance. At the moment, there's almost 40 billion in TVL in DeFi. And as we can see, the lion's share is Ethereum with 58%, and then an additional 9% is all captured by different layer twos, and only 33% are the alternative layer ones and the entire crypto tail, basically. So a lot of smaller projects. So the overall trend here is really that we believe, or how it looks like right now, is that EVM could become a standard in the future. That doesn't mean there could be something new that takes over Ethereum, but as of now, we see that clear trend and a consolidation towards EVM. And I think that that's something you should watch out for.
And one of the counter theses as well to what you just said is that we're just looking at smart contract platforms, right? Because a lot of investors in the audience can say, what about Bitcoin? So Bitcoin is definitely non-EVM, right? So Bitcoin is like Android or Linux or Microsoft Windows. But Bitcoin can evolve as well. So once Bitcoin becomes also with features like smart contracts, and you can have decentralized finance applications, of course, the lion's share of Ethereum is going to decrease. The same way now we have a duopoly between iOS and Android when you're using a smartphone, right? So these are the things that we're going to keep an eye on. But definitely when it comes to the current state of operating systems, Ethereum is the most dominant smart contract platforms. However, Bitcoin can evolve as well. And we're seeing already discussions in forums, but also new developments and proposals to, for example, have scaling solutions built and compatible with Bitcoin, for example. There is a great project that is working with cryptographers today called ZeroSync that actually tries to build a layer 2 on top of Bitcoin to scale Bitcoin to more than 10 transactions per second. Because currently Bitcoin only processes 10 transactions per second, Ethereum is around 40 transactions per second. But when we include scaling solutions, there is a multiplier to the throughput of transactions that gets to thousands or hundreds of thousands of transactions per second, depending also on how the technology is being built. All right, now let's talk about another theme. We're looking at the current macro state. We know today that crypto assets are also macro assets alongside a macro infrastructure for payments. And it means that with the rise of interest rates, whether it's in the UK with gilts or whether it's the US Treasuries, we're seeing more and more interest to have access to US Treasuries on the blockchain. Tom, tell us more about what you're seeing on the market today and why US Treasuries are outpacing the appetite for the DeFi yield that was actually very dominant in a very low interest rates environment that we experienced in the past 10 years.
So before March 2022, which is the start of the interest rate hikes, we've seen that DeFi yield has been quite competitive. And one of the key reasons is because DeFi products cuts out the middleman. For example, banks take a huge share from the interest rate spread and take a huge cut from the net interest margin. However, on decentralized lending protocols like Aave, they don't take a huge cut on that. And therefore, you can see that DeFi yields has been quite competitive previously. However, when the Fed start raising interest rate from 0.8% to right now to around 5.4%, we've seen that DeFi yield has been becoming less and less competitive. Let's not take into account those strategies with huge risk. We're just talking about similar situations if you deposit stablecoins on a centralized lending protocol like Aave or Compound. Right now, you're just still getting around 3 to 4%. In comparison, while US Treasury can yield a much higher yield, we've seen that a lot of users actually are flying their capital out from the crypto ecosystem back to the traditional market as they can offer a much safer yield while you're offering a higher interest rate as well. So on the right-hand side, we can see a chart. So the yellow line is the SPY AUM, which is the iShares 1 to 3 years Treasury bond ETF AUM from March 2022. The AUM is around 20 billion. And to its peak, the end of 2022, the AUM has risen to around $30 billion. And in the meantime, we've seen that stablecoin market cap, which is a key indicator of the DeFi appetite. So you've seen that after the collapse of Terra and Luna, as well as the banking crisis, it has dropped more than 33% in terms of the stablecoin market cap. Until now, the US Treasury has seen around 40% growth compared to March 2022 in terms of the AUM, while in comparison, if we use S&P 500 index, we have seen that there are only around 10% growth of this fund as well. So you've seen that there are a lot of appetite towards a US Treasury bond ETF. And therefore, it's also causing a drop in DeFi total AUM. As you can see, I've just mentioned that the total value of DeFi has dropped more than 70%. But why does it matter to investors or to the crypto community in general? A silver lining we can share is DeFi is actually moving away. We've seen that yields are not as competitive as previously. And right now, we've seen that the largest sector in DeFi is actually trying to provide organic yield to the users by providing the yield coming from staking rewards from different smart contract platforms. For example, right now, let's use an example of the largest DeFi protocol, Lido, which is around 10 billion asset under management. And right now, for the Ethereum product called Staked Ethereum, they're offering around 3 to 4% yield. And in the meantime, that has already attracted a lot of users' appetite to deposit their assets and gain yield from a sustainable yield towards Ethereum, this asset. And in the meantime, throughout this bear market, we can also see the resilience in DeFi as well. From time to time, we're seeing that centralized exchange during a huge liquidation or huge market drawdown, it may sometimes have a huge congestion on their back end as well. But then on DeFi, we've seen that it operates flawlessly. There are no downtime. They operate 24/7. Liquidations is just flawlessly, seamlessly operated because lending markets in DeFi right now is using an over-collateralized manner. And therefore, we've seen that there are no near to zero bad debts that has been occurred so far. And compared to the lending markets, we've seen that over 2022, there are several large lending markets, centralized lending markets, collapses such as Celsius and BlockFi, whereas there is near to zero lending markets that have collapsed in DeFi. Adrian and Ellie, do you have anything to add here?
I don't have anything to add. This is a great point, Tom, and I couldn't agree more. And I think this is a good segue to the question that I have for you guys. What about an environment where we know that the Federal Reserve, as Lina mentioned, are going to fight for getting back to the benchmark of 2% inflation, right? Which means that, of course, the rates are going to come down. What would you see in the future when essentially DeFi at some point may also compete against the yield for, again, a low interest rate environment, or probably for at least the medium term, we're going to have heightened interest rates until, of course, the inflationary pressure comes down. Even though, of course, when we're looking at CPI numbers, we know that these are backward-looking numbers and not forward-looking ones, where we could see, for example, the relocation of the chip industry in the US instead of basically using globalization in order to basically build phones and over devices. So where do you see the market headed, especially when now we're seeing the convergence between TradFi and DeFi for US Treasury strategies? We can also see that for gilts in the UK, or also like for the euro, the other people can get as well in the European Union. Where do you see the market if we get back to such a low interest rate environment?
Adrian, do you want to take this?
Yeah, absolutely. So first of all, I do believe there's a high probability that we're gonna see elevated interest rates for longer than expected. I think that was revealed by Jerome Powell as well during his Jackson Hole speech. I don't think, and I would say the market agrees, if we look at the CME watch tool for the next FOMC meeting, I think the majority thinks that interest rates will stay the same, but elevated for longer, basically. Obviously, I think the challenges for DeFi will stay for now. They really have to come up with innovative ideas in order to capture new users. But obviously, once we go again towards lower interest rates, we could see an influx of liquidity into the DeFi sector again. But I think Tom mentioned it, DeFi was very resilient in any market turbulences. And in my opinion, DeFi is really about financial infrastructure. And I think we've seen the early innings of new technology and new innovation happening in the DeFi space that also speaks for that convergence between traditional finance and decentralized finance. And I think that's also a segue to our last bigger trend.
One point I want to add is it is also presenting a key challenge to DeFi, forcing them to keep innovating. When you're seeing people leaving the crypto market for high yield in TradFi, so the projects need to think about like how can we offer similar yields, right? Like for example, like USDC, they have this backing in treasury, so they're earning that much. How can a decentralized stablecoin, like the largest decentralized stablecoin right now is MakerDAO's DAI, how can they be as competitive at this as like US Treasury, for example, or a newer project called Libra? So they're still testing out their innovation and their thesis and technology as well, but then they have come up with a nice theory and a nice mechanism of using Ethereum's staked Ethereum, which is a product from Lido. Essentially, it is a yield generating collateral so that it can also provide yield for stablecoin holders. So when users deposit stake ETH into Libra, and then it will mint USD, and since the collateral is generating yield, the protocol can shift the interest rate coming from the stake ETH back to the stablecoin holder, so that the stablecoin holder is actually generating yield on themselves without doing anything. But then, of course, there are smart contract risks, but then we are seeing more DeFi protocols are trying to innovate and provide better user experience to the users in DeFi.
But I think when we take a step back to what you just said, Tom, what is important for investors is to look at the risk matters, but also the risk spectrum, right? So you have, on the one hand, the risk-free rates of the government, right? And it depends again on the macro environment, whether it's like a high interest rate environment or a low interest rate environment, depending on the state of the economy and the geopolitical conflicts. And then on the other end, you have the higher risk premiums that comes along with liquidity risk, market risk, and of course, the counterparty risk as well. And I think crypto is on the other end of the spectrum that comes along with a higher growth prospect compared to a risk-free rate, right? So this is where they compete, because at the end of the day, unless, of course, the digital economy built on top of Bitcoin or Ethereum becomes a new digital economy similar to the Silicon Valley, and then it means that at some point with more maturity and sustainability, they would become other type of economies that we could actually compete against a country, right? So these are the things to look at as well as DeFi mature. When we look at the age and the maturity of DeFi, it's just like 2-3 years old, right? There's a lot to be built so far, but these are the foundation and the building blocks of what could come next, right? So there's a great book by Balaji, the former CTO of Coinbase, writing about basically how digital networks could become also the next type of economies and countries in the future, right? So these are the things that we could see as well with Ethereum and other smart contract platforms as they build economies on top. Of course, converge with the real world environment that we have with US Treasuries and other real world assets.
Absolutely.
Tell us more about what we're seeing as well, especially this is a good segue to what we just discussed. Now that we're seeing liquidity moving from centralized exchanges, especially since the collapse of FTX, to decentralized exchanges, where of course there is more liquidity to some extent on some of these new applications built on Ethereum.
So first of all, we are seeing that since the FTX collapse, a lot of these centralized exchanges actually lost a lot of its balance. It has shown that the ethos of crypto is actually hold your own keys, is like self-custody. So we've seen that a lot of assets actually withdrawn from centralized exchange. A lot of people decide to try to learn how to use self-custody assets. So that's a key trend that we've been seeing. And then right after FTX, the cold wallet developer ledger actually shared the key stats of their sales actually increased tremendously after the decentralized exchange collapse. So what it has been highlighting is DeFi is absolutely an integral part of crypto. And then when we're using centralized party, we definitely need to understand what the potential risk of decentralized parties Are they separating their assets with their own treasury, as we have seen that FTX? They're mixing their own assets with customers' funds. So that's really a red flag. And that's also a highlight to users that when you're using centralized parties, make sure you need to understand what are the mechanisms behind it. Is it safe to use? Are they separating their funds with separated custody accounts? So that's really important. And back to our previous point, we've seen that the convergence of blockchain with real-world assets. As Ellie also mentioned, that with the appetite towards U.S. Treasury is increasing, given that the yield is higher, the risk is lower as well. We've seen that the size of tokenized U.S. Treasury actually grown by 448% year to date. And the largest product issued is by Franklin Templeton with more than around 300 million asset under management on the Stellar blockchain. So it has shown that a lot of institutional players are already leveraging blockchain technology to issue and tokenize a traditional finance product on-chain to provide a more seamless experience to users as well. And in the meantime, we also see that crypto projects are leveraging this trend as well. The largest protocol in terms of decentralized stablecoin, MakerDAO, also increased its 24% for exposure to real-world assets as well. So the real-world assets acquisition included liquid bonds and U.S. Treasury to boost their earnings of their own protocol. So during a bear market, if you're holding volatile assets in your treasury, definitely you might encounter a really high market risk and price impact of your treasury. And holding a yield-generating instrument is definitely a benefit for your protocol's long-term growth as well. And why does it matter is to maintain liquidity and capital. So once you invest in the instruments or funds, you actually still keep the tokens on your wallet. So what you can do is still, whenever there's anything or any time, you can just trade it on the decentralized exchange 24/7, as opposed to the traditional market. You need to wait for the holidays to go over, you need to wait for the office hours, so on and so forth. But in crypto, it's 24/7. If you are using an automated market maker, as long as there's liquidity, you can trade it. And then another benefit for crypto project is exposing to real world assets. As mentioned previously, it can diversify your treasury balance sheet to assets that without smart contract risk. So they have a counterparty from the traditional finance space directly helping them to invest in this US Treasury bond so that they can help them to achieve higher yield during the bear market.
This is really incredible because this is really a testament to the convergence between traditional finance and crypto. But most importantly, Tom, I have a question for you, which is more of a bet. And of course, this is advice for anyone in the audience. Tell us, where do you see the figure going for real-world assets on the blockchain? For tokenization, what would be the total addressable market or the total AUM for all of these protocols by the end of the year, December 31st?
At the end of this year, that's a really good question. I would say a really conservative number. I would say 1 billion at least. Yeah, that's my bet.
Okay. Sounds good. We're going to hold you accountable for that, Tom, if you remember this. But this is great. This is really fantastic. We're going to move on to the Q&A session. If anyone has any question, feel free to shoot in the Q&A on this call. You can also find our data dashboards on the blockchain, on Dune Analytics. You can also find our research reports as well, whether it's the newsletter on the weekly basis, the monthly recap on the monthly basis, or even our flagship quarterly magazine that we publish called The State of Crypto. So you can actually scan this QR code so that you can sign up for the newsletter. And apologies for that because the URL is 21shares.com/insights and not /research. We just changed it very recently. All right, let me stop sharing my screen. I think we do have a question in the audience. Will it be possible to receive this research doc after the call? Yes, absolutely. Big yes, you're going to receive it. It's going to be available to you to your email address. So check it out after this call. We're going to send you also our resources and all of the key research reports and webinars that we actually posted in the past. All right, great. Do we have any other questions? I have a question for you, Lina. Where do you see the market going for anything that you just discussed previously? I know that there is the conversion that we mentioned between DeFi and TradFi. Is there any risk that investors should be aware about? Is there anything that you're super excited about that you want to showcase before we wrap up the call?
Absolutely. Actually, one segment that I am looking forward to see more popping up on our feeds, SocialFi, that Adrian alluded to earlier in the friend.tech on Base. I am actually really excited to see what's going to come next and what friend.tech will actually evolve into. I see an increasing demand for social media to be on-chain and to be integrated with crypto. I'm excited to see what's going to happen next.
Yeah, absolutely. I think it's a broader theme, especially when it comes to how this is going to look like. Is it going to be, because when we think about the core values of crypto, it's decentralization of your identity, decentralization of your data, decentralization of the value that you have over the internet. It's also like ownership, right? So it's both like decentralization and ownership. And these are the core values that we could see with social media, where these can protect freedom of speech, but also at the same time protecting your online identity as well when it comes to how do you interact on the internet today and how do you express yourself and build a community around a brand, whether it's personal or corporate. And I think these are the clear themes that we are definitely seeing with crypto, where there is a clear convergence between different solutions that exist out there. And actually, it's a good, I would say, TLDR or highlight for our next magazine as well. We don't want to spoil the party, but we're working on a great magazine for the end of this quarter. So stay tuned for that because we have a lot to unpack there too. I think we do have a question in the audience. Where do you store your crypto assets for 21 shares ETFs? So it's publicly available, of course, on our website. We're using institutional grade custodians for our ETPs, exchange traded products. So we're using multiple custodians. It depends on of course, the product that we are offering, whether it's an index, a single assets, or a short product. So check out our website for each product. But we're using institutional grade independent custodians that are ring-fenced away from the company. I have one more question. Do you think about crypto index products, especially in DeFi, top 10, DeFi layer 1, layer 2 indices, so thematic indices? Do you see a possible use trend for these kind of products in the nearest future? This is music to our ears. Adrian, you want to take this one?
Yeah, absolutely. Yeah, I think so. I do think so. There could be a trend around index or basket solutions in the crypto space as well. I think one major challenge within crypto is interoperability. So we do have a lot of different ecosystems, a lot of different layer ones that can speak to each other. And therefore we have siloed liquidity. And therefore, interoperability is still one big challenge that we have to solve. However, once solved, I think there is a path and a place for basket solutions as well. And it will start with smaller crypto baskets, but I think the big trend is towards ETFs, any financial product, moving on chain as well. I think that's the longer term picture basically here. Tokens are the future ETFs, basically, in my opinion.
Great. No, absolutely. I couldn't agree more. And I think it depends also on the maturity of the overall category that we're trying to wrap into a theme. And that's why actually we came up with the classification standard in partnership with CoinGecko, the largest data provider in crypto for market prices. So check it out. It's available also on our website. You're going to receive it by email. So what we did is launching a standard very similar to GICS for the stock market, where you can categorize financial companies, military, cybersecurity, and other type of sectors and industries that exist today in traditional finance. And we apply the same framework and expanded that framework to crypto as well, because crypto is no different. People are talking about coins, but they're not currencies. It's a misnomer. These are clear technologies and also ecosystems that are going to evolve in a similar way to the software as a service industry and also the internet innovation that we've seen in the early 1990s. This is just the beginning, of course, but our standard is actually placing and putting in perspective how investors should view crypto, and not as a single-ended, I would say, asset class, but a asset class with subcategories that could become in and of themselves sub-asset classes as well. Okay, thank you very much. The last question is not a question per se, but it's more an answer to what you just mentioned, Adrian, which is like, the person is developing these kind of DeFi projects, and that's why they're interested as well. Feel free to reach out to us via email if you have any questions around DeFi. We do have a lot of dashboards as well when you can look into what's the evolution of decentralized exchanges, the evolution of lending protocols, also the stablecoin rate and the peg level as well for each stablecoin. So there's a lot of dashboards that you can unpack there. If you're interested into investigative research and forensic research, we do have a lot of dashboards looking at the FTX and Alameda addresses, even the US government addresses as well, on-chain, available in real time. So check it out on Dune Analytics.
Always feel free to reach out to us. We are very approachable, and we're always happy to bounce ideas, brainstorm, and just connect with people from the space.
Absolutely. And you can also find us on Twitter as well. But feel free to reach out to research@21shares.com, and we'll be able to expand the conversation and organize calls as well if you want. We have another question here as well. What are your expectations about EIP 4844, called the Cancun upgrade? Do you think it will be delayed after Q4 2023? Do you expect a solid price impact on Ethereum? Tom, why don't you take this one?
So the crux of EIP 4844 is to introduce a new type of data storage called blob. And this blob transaction will be dedicated to store the core data, which is like transaction data for layer 2 scaling solution for Ethereum, which Adrian also mentioned, which includes Arbitrum, Optimism, Polygon ZK EVM. So right now, because to transact on layer 2 is much lower than Ethereum, it's around 10 cents, 20 cents. But then, is it cheap enough? Not really. When users transacting on a blockchain, users might need to submit like hundreds, thousands of transactions per day for more sophisticated players in the space, for traditional finance players as well. So in the future, if you want to minimize the cost for layer 2 scaling, you will need to use a dedicated data storage for this type of transaction data. And therefore, EIP 4844 can introduce this new type of storage so that they don't need to go through the initial gas mechanism from Ethereum, because the initial gas mechanism on Ethereum is based on the demand of the networks, and it's very congested most of the time because most of the usage, most of the network activities are based on mainnet right now. And if we can introduce this new type of data storage called blob, it can significantly reduce the time and reduce the cost for layer 2 solutions to submit their core data back on Ethereum, as well as the state update as well. So mainly, there are two main costs for layer 2 scaling solution. One is core data input, so that they need to post the core data, transaction data, back to the layer 1 blockchain. And another cost is called the state update, and they need to update the layer 2 state back on Ethereum. So whenever they update these two types of data, they will need to incur gas, and this block can help them drastically. And in terms of the timeline, there's no concrete timeline yet. It might delay or it might be delivered on time. We don't have a concrete timeline from the developers yet. And price impact, we can't always forecast the price anyways, but definitely is helping the Ethereum ecosystem to grow and the layer 2 scaling solutions in the long run.
So the TLDR is this new upgrade is a reduction of the cost that people pay for transacting on the Ethereum blockchain and other layers on top. Very important, because at the end of the day, we want to onboard billions of people within the blockchain ecosystem. And that requires a great user experience, right? People should actually have this leapfrog of user behaviors from using Western unions to using actually the blockchain technology like Ethereum to transact more freely over the internet. And that's a huge upgrade. And of course, because Ethereum was able to pull multiple upgrades over the past, I would say 18 months, starting with a merge, and then of course, making sure that finally we do have the Shanghai upgrade that made the liquidity possible with staking. We know that they're going to pull this up, right? We don't expect them to delay it so much, and having these memes over the internet, seeing Vitalik at 80 years old and still talking about the merge, now we know that it's going to become a reality. So these are the things that we're super excited about. It may have an impact on the narrative, on how Ethereum is becoming more and more the de facto settlement layer for Web3. And that's, of course, one of the biggest, I would say, upside for Ethereum as well, alongside, of course, what we discussed with tokenization, where basically like all the tokenization strategies right now are happening only on Ethereum. There is also Stellar, as Tom mentioned, there's also Avalanche, but like the bulk of the innovation is really happening on Ethereum, the same way we're seeing the bulk of innovation around the world really happening in the Silicon Valley. In spite of the fact that, of course, there's over startup ecosystems that are highly relevant, whether it's like Berlin, Israel, Paris, Shanghai, etc. Do we have any other questions? Otherwise, this will be a wrap. And it seems to be like one. I know we have 5 more minutes. Feel free not to be shy. But other than that, like, I really want to thank you guys for really making this call a great conversation. I hope it was very helpful for the audience to really learn more about crypto, learn more about our views on the market. You're going to receive the presentation and the slide deck after this call. And of course, feel free to reach out to the research team at research@21shares.com. We are on multiple time zones, so you're always going to have a response very promptly. All right, Lena, Adrienne, Tom, thank you so much. It was amazing.
Thank you, Eli.
You.
Thank you so much.
Thank you.
Everyone, bye-bye.
Bye-bye.
Bye-bye.